When everyone else is selling in panic, that's when the real opportunities emerge. I've built my career on understanding this fundamental truth. Throughout my decades in the investment world, I've learned that recessions don't destroy wealth, they transfer it. And the transfer happens from those who panic to those who prepare. Today, I want to share with you the 3 value stocks that I believe represent the best opportunities when economic storms hit. But before I tell you which companies made my list, let me explain why my approach to recession investing is different from what you'll hear from most people on Wall Street. Most investors treat recessions like unpredictable natural disasters. They build complex models trying to predict when the next downturn will arrive. They watch economic indicators obsessively. They panic when markets turn red. I take a completely different view. I don't waste time trying to predict recessions because short-term market and economic prognostication is largely a fool's errand. Instead, I focus my energy on finding businesses so exceptional that they'll not only survive recessions, they'll emerge stronger on the other side. That's the real secret. It's not about timing the market. It's about owning companies with such powerful competitive advantages that economic cycles become almost irrelevant to their long-term value. I learned this lesson early in my career, though I'd be lying if I said I never made mistakes along the way. When I founded Pershing Square Capital Management in 2004, I was already convinced that concentrated bets on high-quality businesses would outperform broad diversification. But it took several painful experiences for me to truly understand what separates a good business from a truly exceptional one. The companies that survive recessions and thrive afterward share specific characteristics. They're predictable, they generate enormous amounts of free cash flow, they dominate their markets with barriers to entry so high that competitors simply cannot replicate their success. And most importantly, they have conservative balance sheets that allow them to weather any storm. Think about it this way. During the financial crisis of 2008 and 2009, countless companies collapsed. Household names disappeared overnight. But some businesses barely noticed the chaos. They kept generating cash, they kept serving customers, they even acquired distressed competitors at fire sale prices. Those are the companies I want to own, especially heading into a recession, because when credit markets freeze and weaker competitors fail, dominant companies with fortress balance sheets can play offense while everyone else plays defense. The first stock I'd buy in a recession is one that might surprise you, but it perfectly demonstrates my investment philosophy. It's a company I've owned in various forms throughout my career. A business so predictable, so dominant, so simple, that it represents everything I look for in an investment. I'm talking about the fast food and restaurant sector, specifically focusing on companies with franchise business models. Let me explain why this matters so much during recessions. When economic times get tough, people change their spending habits. They cut back on expensive luxuries, they postpone big purchases, but they still need to eat. The restaurant industry as a whole doesn't disappear during recessions, it just shifts. People trade down from expensive dining experiences to more affordable options. This is where companies with strong brands and value propositions absolutely dominate. I've invested in several restaurant companies over my career, and one stands out as particularly recession resistant. It's a business that essentially operates as a royalty company. The parent company doesn't actually run most of the individual restaurants. Franchisees do that, taking on the operational risks and capital requirements. The parent company simply collects a percentage of every sale. Think about this business model during a recession. The franchisees bear the brunt of any sales decline. The parent company's revenue might decrease somewhat, but their profit margins remain incredibly stable because they have minimal operating costs. They're not paying to cook food or serve customers. They're simply collecting their royalty on every transaction. It's one of the most beautiful business models in the world. During the last several recessions, while other restaurant companies struggled with debt burdens and declining traffic, the major franchise operators maintained profitability. Some even expanded by acquiring weaker competitors or taking over failed franchise locations at distressed prices. The specific company I favor has operations spanning multiple countries, giving it geographic diversification that further reduces risk. They own several brand names you'd recognize immediately. Some focus on coffee and breakfast. Others specialize in burgers and chicken. This portfolio approach means they're not dependent on any single concept or consumer trend. When one brand faces challenges, others compensate. I've analyzed their performance through multiple economic cycles, and the pattern is remarkably consistent. Sales might temporarily decline during severe recessions, but the company maintains healthy profit margins and continues generating substantial free cash flow. That cash flow gives them options. They can buy back stock at depressed prices. They can invest in renovating locations. They can acquire competitors, all while weaker companies are fighting for survival. The valuation during recessions typically becomes incredibly attractive. When markets panic and sell indiscriminately, quality businesses get thrown out with the garbage. I've seen this company trade at single-digit price-to-earnings multiples during severe market stress, despite having one of the best business models in the entire consumer sector. Those moments represent generational buying opportunities. You're acquiring a royalty stream on billions of transactions worldwide at prices that make absolutely no sense given the company's competitive position. Now, let me address the obvious concern. Won't restaurant traffic decline in a recession? Yes, it will. But the decline is typically modest and temporary. People still need to eat, and value-oriented fast food often gains market share as consumers trade down for more expensive options. The franchisees bear most of the pain from reduced traffic because they still have fixed costs like rent and labor. The parent company's royalty model insulates them from the worst effects. This is exactly the kind of structural advantage I look for. A business model that shifts risk away from shareholders while maintaining upside participation. The second stock I'd buy in a recession operates in a completely different industry, but it shares the same core characteristics I just described. It's a business I've owned for years, and it represents one of my highest conviction positions. I'm talking about home improvement, retail, specifically the duopoly that dominates this massive market in North America. When I first invested in the home improvement sector, some people questioned the logic. After all, home improvement spending typically declines during recessions as consumers postpone discretionary projects. But that surface-level analysis misses several critical factors that make the leading home improvement retailers incredibly attractive during downturns. First, understand the market structure. Two companies control the vast majority of professional and consumer home improvement spending in the United States and Canada. They've built such extensive networks of stores, developed such strong supplier relationships, and created such efficient distribution systems that no competitor can realistically challenge their position. The barriers to entry are enormous. Think about what would be required to compete with these companies. You'd need to build hundreds of massive stores in prime locations. You'd need to establish relationships with thousands of suppliers. You'd need to develop sophisticated logistics networks to keep those stores stocked with hundreds of thousands of individual products. You'd need to train tens of thousands of employees. And you'd need to do all of this while competing against established players with decades of experience and massive scale advantages. It's essentially impossible. This is what I mean by a moat, a competitive advantage so powerful that it's effectively a permanent barrier to competition. During recessions, this moat becomes even more valuable. Weaker competitors fail or pull back. The dominant players can negotiate better terms with suppliers who desperately need their volume. They can acquire distressed assets at favorable prices. They can invest in technology and efficiency improvements while competitors are cutting back. They emerge from recessions with even stronger competitive positions than before. I've watched this pattern play out multiple times over the past several decades. But here's what makes home improvement retail particularly interesting during economic downturns. The business has several natural hedges that many investors don't fully appreciate. When new home construction slows during a recession, which it always does, homeowners maintain and repair their existing homes more intensively. When people can't afford to move to a new house, they renovate their current one instead. This repair and remodeling demand provides a floor under revenues even during severe recessions. The customer base is also remarkably stable. Professional contractors represent a huge portion of revenue, and these customers need to continue working regardless of economic conditions. Homes don't stop needing repairs just because the economy is struggling. Roofs leak, pipes burst, electrical systems need upgrades. This creates a steady stream of demand that persists through all phases of the economic cycle. Let me tell you about the returns I've seen from my position in one of these home improvement retailers. I invested at what I initially thought were attractive prices. The company was trading at a reasonable valuation, generating solid free cash flow, and had excellent management. But what happened over the following years exceeded even my optimistic expectations. The stock increased by well over 100% as the market gradually recognized the quality of the business model and the strength of the competitive position. The company used its cash flow brilliantly. They bought back enormous amounts of stock, shrinking the share count significantly. They invested in e-commerce capabilities and supply chain improvements. They maintained a conservative balance sheet that gave them flexibility during market volatility. This is capital allocation at its finest. and it's a critical component of what makes a business exceptional. Good management teams don't just run good operations. They make smart decisions about how to deploy the cash those operations generate. During a recession, I'd be thrilled to add to my position in home improvement retail at distressed prices. The business model works regardless of economic conditions. The competitive moat is permanent, the management teams are excellent, and the valuation during market panics often becomes absurdly cheap relative to the long-term cash flows these businesses generate. This is exactly what value investing is supposed to be about: finding exceptional businesses and buying them when fear creates irrational pricing. The third and final stock I'd buy in a recession is perhaps the most important position in my entire portfolio, and it represents a bet on the future of technology and information access. I'm talking about Alphabet, the parent company of Google. Now, I know what some of you are thinking. A technology company as a recession hedge? That sounds counterintuitive. But let me explain why Alphabet is actually one of the safest, most predictable businesses in the entire world. Start with the business model. Google Search dominates online search with a market share so overwhelming that it's essentially a monopoly. When you or I or anyone else in the developed world needs to find information, we Google it. The verb itself has become synonymous with internet search. This isn't just brand recognition, it's complete market dominance, built on a product that's genuinely superior to any alternative. The algorithm works better, the results are more relevant, the user experience is seamless. Competitors have spent billions of dollars trying to challenge Google Search, and they've all failed. The business model is simple and beautiful. Advertisers pay Google every time someone clicks on their ads. Google has no inventory to manage. They don't manufacture physical products. They don't have complex supply chains. They're simply matching advertisers with potential customers and taking a cut of every transaction. It's a digital royalty business with profit margins that most companies can only dream about. During recessions, advertising budgets typically decline. That's true. But here's what makes Google's model so resilient. The company doesn't rely on brand advertising or awareness campaigns. They sell performance advertising. Advertisers can see exactly how much revenue each advertising dollar generates. If they spend $100 on Google Ads and generate $150 in sales, they're going to keep advertising regardless of what the economy is doing. That direct measurability and return on investment makes Google advertising much more recession-resistant than traditional advertising channels. I've studied Alphabet's financial performance through economic cycles, and the consistency remarkable. Revenue growth might slow during recessions, but it doesn't decline. The company continues generating enormous amounts of free cash flow. That cash flow gives them incredible strategic flexibility. They can invest in new technologies. They can acquire competitors or complementary businesses. They can return cash to shareholders through buybacks, all while maintaining a fortress balance sheet with over $100 billion in cash and no meaningful debt. The competitive moat around Google Search is essentially permanent. It's built on network effects that become stronger over time. Every search query makes the algorithm slightly better. Every click provides more data to improve ad targeting. Every advertiser who joins the platform makes it more valuable for users and for other advertisers. This virtuous cycle has been running for over 2 decades, and there's no sign it's going to stop. But Alphabet isn't just Google Search. They own YouTube, which has become the dominant platform for video content worldwide. They own Android, the operating system that powers the majority of smartphones globally. They have Google Cloud, which is growing rapidly in the enormous cloud computing market. They own Google Maps, which has become essential infrastructure for both consumers and businesses. This portfolio of assets creates multiple layers of competitive advantage and revenue diversification. The artificial intelligence revolution makes Alphabet even more attractive. The company has been investing in AI research and development for over a decade. They have some of the world's best AI researchers and engineers. They have more training data than almost any other company on Earth. All those search queries and YouTube views and Android usage patterns create an unmatched data set for training AI models. As AI becomes more important to business and consumer applications, Alphabet's competitive position should strengthen further. Think about the valuation. During market panics, even dominant technology companies see their stock prices decline significantly. Alphabet has occasionally traded at price-to-earnings multiples in the teens, despite having one of the best business models in human history. When you can buy a company generating over $60 billion in annual free cash flow, growing double digits, with a permanent competitive moat and pristine balance sheet at less than 20 times earnings, that's an extraordinary opportunity. It doesn't happen often, but recessions create exactly these kinds of dislocations. Let me address some concerns that inevitably come up when I discuss Alphabet. Some people worry about regulatory risk. Governments around the world are increasingly scrutinizing large technology companies. There's talk of antitrust action and new regulations. These are legitimate concerns, but I believe they're manageable risks. First, Google provides genuine value to users and advertisers. Breaking up the company wouldn't make anyone better off. Second, the company has resources and sophistication to navigate regulatory challenges. And third, even if regulators force some structural changes, the core search business would remain incredibly valuable. Others worry about competition from AI-powered chatbots and new search paradigms. Could ChatGPT or other AI systems disrupt Google's search monopoly? I've thought deeply about this question, and my conclusion is that AI enhances Google's position rather than threatening it. Google has been integrating AI into search for years. They have the data and technical capabilities to lead the AI revolution. More importantly, they own the distribution channels where billions of people already go for information. Any new technology that wants to reach mainstream users will likely need to work through Google's platforms or compete against Google's resources. The combination of these three stocks creates a portfolio that I believe would perform exceptionally well through a recession and the recovery that follows. Think about what these businesses share. They all generate massive free cash flow. They all have permanent competitive advantages. They all operate with conservative balance sheets. They all have management teams focused on long-term value creation. And they all become significantly undervalued during market panics when investors sell indiscriminately without regard for business quality. This is the essence of value investing. It's not about finding cheap stocks. It's about finding exceptional businesses and buying them at prices below their intrinsic value. Recessions create fear, and fear creates opportunity. When everyone else is selling, you need the conviction to buy. That conviction comes from truly understanding the businesses you own, not from studying charts or following market sentiment. I've structured my entire investment approach around these principles. I maintain a concentrated portfolio because I'd rather own my 10 best ideas than my 100th best idea. I focus on businesses I can understand completely. I look for companies with moats so wide that competitors can't cross them. I demand strong balance sheets because I never want to be forced to sell at the wrong time. And I take a long-term perspective because short-term market volatility is noise that obscures the fundamental value of great businesses. Let me share a broader framework for thinking about recession investing. Most investors make the mistake of trying to time the market. They watch economic indicators and try to predict when the next recession will start. Then they try to sell before the downturn and buy back at the bottom. This approach almost never works because market timing is extraordinarily difficult. The market typically bottoms before the economy does. By the time recession is obvious to everyone, stocks have often already declined significantly. My approach is completely different. I own businesses that I'm comfortable holding through any economic environment. I don't care if we enter a recession next month or 3 years from now because the companies I own will be fine either way. In fact, recessions often present opportunities for these dominant companies to strengthen their competitive positions by acquiring distressed competitors or gaining market share from weaker players who can't survive the downturn. Think about what happened during the financial crisis. The entire financial system nearly collapsed. Credit markets froze. Unemployment soared. It was the most severe recession since the Great Depression. And yet, the best businesses kept operating. They kept generating cash. They kept serving customers. And investors who had the courage and capital to buy during the panic made enormous returns over the following decade. I remember those days vividly. Everyone was terrified. Respected analysts were predicting the end of capitalism. The media coverage was apocalyptic. It would have been easy to panic and sell everything. But I'd done my homework. I understood the businesses I owned. I knew they would survive and eventually thrive. So instead of selling in fear, I looked for opportunities to buy more at distressed prices. One investment I made during that period illustrates the principle perfectly. I invested $60 million in General Growth Properties, which was the second largest mall owner in the United States. The company had filed for bankruptcy with $27 billion of debt. The commercial mortgage-backed securities market had collapsed, and GGP couldn't refinance its obligations. Most investors thought the company was worthless. But I studied the situation carefully and realized that the underlying properties were valuable. The malls themselves weren't going to disappear. They generated steady cash flow from rent. The problem was purely a capital structure issue, not a business model problem. I partnered with Brookfield Asset Management and Fairholme Capital Management to restructure the company. It was complex and challenging work, but by 2010, GGP emerged from bankruptcy and returned to profitability. By 2013, the stock had increased 60% from pre-bankruptcy levels. That investment generated returns that made the risk absolutely worthwhile. But more importantly, it taught me that the best opportunities often appear during periods of maximum fear when everyone else is selling indiscriminately. This brings me to a critical point about recession investing. You need liquidity and you need courage. Liquidity means having cash available to deploy when opportunities appear. If you're fully invested or, worse, leveraged when markets collapse, you can't take advantage of the bargains. This is why I maintain conservative portfolio leverage and always keep some dry powder available. Courage means being willing to buy when everyone else is selling. It means trusting your analysis even when the consensus believes you're wrong. It means looking foolish in the short term to generate exceptional long-term returns. The three stocks I've described today represent the types of businesses I want to own regardless of economic conditions, but especially during recessions. The restaurant franchisor provides a royalty stream on billions of consumer transactions worldwide with a business model that shifts operational risk to franchisees while maintaining steady cash flows. The home improvement retailer dominates a duopoly market with permanent barriers to entry and multiple natural hedges against recession. And Alphabet controls the gateway to information in the digital age, with network effects that create an essentially unassailable competitive position. What ties these companies together is quality. They're not speculative bets or turnaround stories. They're exceptional businesses trading at prices that sometimes don't reflect their true value, especially during recessions when fear overwhelms rational analysis. This is the paradox of value investing. The best businesses often become available at attractive prices only during periods of maximum stress when most investors are too frightened to buy. I want to emphasize something important. The specific stocks matter less than the framework for thinking about recession investing. You might have different opinions about which companies best meet the criteria I've outlined. That's fine. The critical lesson is to focus on business quality, competitive advantages, cash flow generation, and balance sheet strength. If you own businesses with these characteristics and buy them at reasonable prices, recessions become opportunities rather than disasters. Let me address one final concern that many investors have about concentrated portfolios of high-quality stocks. Won't these companies also decline during a recession? Of course they will. No stock is immune to market-wide sell-offs. When fear grips markets, everything goes down together. But here's the key difference. The stock price might decline, but the underlying business value doesn't change nearly as much. A temporary decline in restaurant traffic or home improvement spending doesn't alter the fundamental competitive position of these companies. The moat remains intact. The cash flow generation continues. The long-term value is preserved. This is why I can maintain conviction during market panics. I'm not worried about what the stock price does next week or next month. I'm focused on what the business will be worth in 5 or 10 years. And I know with high confidence that these exceptional companies will be generating enormous cash flows and serving billions of customers regardless of short-term economic fluctuations. The discipline required for this approach cannot be overstated. You need to do extensive research before investing. You need to understand every aspect of the business model, the competitive dynamics, the management quality, the financial structure. You can't just buy a stock because someone else recommends it or because it appears on a list of recession-proof investments. You need conviction that comes from deep understanding. You also need patience. Great businesses don't generate great returns every single year. There are periods when stocks go sideways or decline while the underlying business continues compounding value. Your job as an investor is to hold through those periods rather than panicking and selling at the wrong time. This is where most investors fail. They have the right stocks, but the wrong temperament. They sell during temporary declines and miss the long-term appreciation. I've built my entire career on these principles. Find exceptional businesses, understand them completely, buy them at attractive prices, hold them for years while they compound. It sounds simple, and conceptually it is simple, but implementation requires discipline, patience, and courage that most investors simply don't have. Recessions test these qualities. They separate investors who truly understand what they own from those who are just following trends or tips. When markets decline 20% or 30% or more, when media coverage is uniformly negative, when friends and family question your judgment, you need unshakable conviction in your analysis. That conviction comes from work, from research, from truly understanding the businesses you own at a level that most investors never achieve. The three stocks I've discussed today represent my highest conviction ideas for recession investing, but they also represent the framework I use for all investing. Quality businesses with competitive moats, strong cash flow generation, excellent management, and conservative balance sheets. Buy them at attractive prices, hold them for years, let the magic of compounding do its work. It's not complicated, but it requires discipline that few investors maintain consistently. As I look at markets today, I see both opportunities and risks. Valuations in many areas are elevated. Some sectors seem priced for perfection, but the companies I've described remain attractive long-term holdings, regardless of what happens to the economy over the next few years. If we enter a recession, I'll be looking to add to these positions at more attractive prices. If the economy continues growing, these businesses will continue compounding value. Either outcome is acceptable because I own quality businesses rather than speculating on economic predictions. This is the mindset that has served me well throughout my career. Don't try to predict the unpredictable. Don't time the market. Don't panic during downturns. Instead, own the best businesses in the world, understand them completely, buy them at reasonable prices, and hold them for the long term. Recessions will come and go. Markets will fluctuate. But exceptional businesses with permanent competitive advantages will continue generating value for shareholders through all economic environments. The only three value stocks I'd buy in a recession are businesses that I'd be happy to own forever. The restaurant franchisor collecting royalties on billions of transactions, the home improvement retailer dominating an oligopoly market with multiple natural hedges, and Alphabet, controlling the gateway to information in the digital age with network effects that create an unassailable competitive position. These companies represent quality, competitive advantage, and long-term value creation. During recessions, when fear creates opportunity, these are exactly the types of businesses I want to own.